Vanguard and Fidelity are two of the largest investment firms in the world. Together, they have about $12 trillion of assets under management. And while they have many similarities, there are some key differences in investment choices, fees, and features. In this video, we will explore those differences so you can make an informed brokerage choice. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. Fidelity has an AUM size of $4.2 trillion. Vanguard manages about $7.7 trillion. AUM means assets under management, which means the company doesn't own these assets, they simply manage them. Even though Vanguard started almost 3 decades after Fidelity did, Vanguard has about twice as many assets under management as Fidelity. The first difference between the two firms is in the investment options and accounts. While both Fidelity and Vanguard offer a variety of individual retirement accounts such as IRA, Roth IRA, SEP IRA, Simple IRA, and employer-sponsored retirement accounts, 529 college savings plans, taxable brokerage accounts, and UTMA, UGMA accounts, Fidelity offers an additional account, the HSA or the health savings account, which Vanguard does not provide. Fidelity is a clear choice if you care about keeping all your accounts, including your HSA, under one roof. Regarding actual investment options, Fidelity and Vanguard offer stocks, bonds, CDs, money market funds, mutual funds, ETFs, and options. In addition, Fidelity provides an ability to trade in precious metals and create custom indexes. If you trade options, Fidelity is a cheaper platform compared to Vanguard. The next difference is in the ability to buy fractional shares. While Vanguard does not allow any fractional share trading, Fidelity enables you to buy fractional shares in more than 7,000 stocks and ETFs. So you can start investing with as little as $1 through Fidelity. Let's say you are just starting to invest and only have $100 and want to buy a stock trading at $1,000 per share. You cannot buy the stock on Vanguard platform, but you can buy a 1/10 of a share through Fidelity. So Fidelity is very beginner friendly. The next difference is in minimum investment requirements. Vanguard requires a minimum initial investment of $1,000 for Vanguard target retirement funds and $3,000 for most active and passively traded funds. Fidelity, on the other hand, requires no minimums. So if you're just starting to invest or want to get your feet wet, Fidelity may be the way to go. The next difference is in pricing or fees. I talked about how vital fees are in your investment journey in this video. Even seemingly low fees can accumulate over the long run and affect your investment returns significantly. Both Vanguard and Fidelity offer indexed funds with low expense ratios. Fidelity offers some funds with zero fees. Zero. You pay no fees whatsoever if you buy these 4 funds, FZROX or FZILX, which are broad market index funds in the domestic and international markets. Vanguard funds aren't too far behind either. The expense ratio is meager, and over the long run, the differential between comparable Fidelity and Vanguard index fund returns is negligible. Vanguard offers more than 300 funds, both active and passive, with an expense ratio of 30 basis points or less. Fidelity offers about 60 funds with comparable expense ratios. Vanguard offers a broad selection of passive funds with over 200 passive funds. Fidelity, on the other hand, has a smaller selection with about 60 passive funds. I talked about passive funds in this video. You don't need more than 4 passive funds in your portfolio. In addition to mutual funds, Vanguard also offers a range of ETFs. For example, if you don't have the $3,000 minimum investment required to purchase the Vanguard mutual fund VTSAX, you could choose the comparable ETF VTI that Vanguard offers. The expense ratios of the mutual fund and the ETF are very low. Fidelity has a broader selection of actively managed funds with about 258 active funds compared to 120 actively managed funds offered by Vanguard. Actively managed funds almost always underperform passive funds over the long term after fees are factored in, especially in the domestic equity market in the US. International equity managers may have better opportunities to generate attractive excess returns than their passive counterparts. However, you must pay attention to fees. Most of these excess returns may disappear after subtracting expenses, which may be higher for retail investors than institutional investors. If you plan to be a more active trader and need advanced charting tools, Fidelity is the better option for you. Vanguard has limited analytical and research tools. I highly recommend against day trading unless you know what you're doing. In sum, Vanguard and Fidelity are both excellent choices. They have great customer service. You can contact them if you're stuck. Vanguard phone support is available during regular work hours, 8 a.m. to 8 p.m. on weekdays or working days. On the other hand, Fidelity's phone support is available 24/7, so you can call them any time of the day if you're stuck. Pay attention to the types of funds you choose regardless of the investment firm you opt for. Bond funds, which have tax consequences, for example, are suitable for tax-exempt accounts. I can't stress enough the importance of paying attention to fees. I have a mutual fund fee calculator linked in the description and how it impacts your total returns at the end of your investment horizon. It tells you the explicit costs of investing and the implicit costs that most people tend to ignore. These are the hidden costs that will impact your investments by a greater amount over the long run. If you found this video valuable, please share it forward and like this video and subscribe to my channel if you haven't already. Your support keeps me motivated to create great educational content for you. Let me know in the comments what else you want to hear. As always, don't forget to be happy, to be kind, and to be your best self. I'll see you in the following video. Bye.